What's up, YouTube? What's going on, CCI family? It's your main man back with the game plan once again, because, well, you already know, can't leave you out there too long without no information and education, you feel me? So, look, I just want to step in here for a quick moment, not only to make sure you're loving the new setup, but to let you know that although all these characters that I'm creating are fictional, and the resumes that I make for them are fictional, all of the information that you're getting, 100% of it, is accurate, up to date, and essential for you in the market today. All the information is from me, through them, to you. I triple check. All my information is always just as I did before speaking it to you, myself, okay? So you can always know that the information is dependable, 100%. Okay, I'm just doing this because it feels like the right thing to do in the new age. It's never been done before. I'm a pioneer at this, getting better with each and every episode, giving these characters life, making it a little bit more interesting for everyone else who is interested in stocks or who's already in the game, okay? Giving us a little something more entertaining to keep your eyes glued to, okay? And again, I hope you're loving it. It's more and more coming. I have plenty more characters that I'm creating and have created that are going to be appearing, and I think you're gonna love them. I love your feedback in the comments below. And with that said, let's get the episode started. Get the pens and pads out.
Good afternoon, CTI family. Some of you may know my guest today from his many real estate ventures, but he's also a savvy investor. Today, we have the pleasure of speaking with Alex Bass. So Alex, welcome to the show today. We're excited to have you with us. For those who may not know you yet, tell us a little about yourself.
Thanks, Avette. I'm excited to be here now. For those who don't know me, I started out with a modest portfolio and grew it significantly during the tech boom of the 2020s. Along the way, I became an early backer of companies like SMCI and Joby, which really shaped my approach to growth investing. At the same time, I built a real estate portfolio of over 50 rental units, focusing on what I call my cash flow first mantra. Today, I combine those two worlds, growth stocks and real estate, to create diversified strategies that balance stability with opportunity. My passion is making complex investing ideas simple and showing people how to build wealth step by step.
Alex, for those of us anticipating a Santa rally or hoping for a rate cut, what should really be the goal as we head into the new year, especially when it comes to positioning in growth stocks and beyond?
That's a great question, Avette. When we talk about a potential Santa rally or the impact of a rate cut, the real goal for investors should be consistency and positioning. Growth stocks are often the first to benefit when markets turn optimistic because they thrive on future earnings potential. Companies like Palantir, Grab, Applied Digital, and of course Nvidia are classic examples of growth-oriented plays. They're not about steady dividends today. They're about scaling technology, data, and AI for tomorrow. And that's why they can swing sharply when sentiment shifts. Now, the way to approach these names isn't to try and time every tick. It's through dollar cost averaging, steadily buying in over weeks or months. That way you're smoothing out the volatility. If Palantir dips 5% one week and Nvidia rallies 10% the next, your average cost basis keeps you balanced. Rather than chasing highs or panicking at lows, over time, that discipline is what really builds wealth in growth.
Great advice, Alex. Now we also have a caller on the line with a question. Terrence T. from Pittsburgh, Pennsylvania. Terrence,
Yes,
are you there?
I'm here. And thank you so much for taking my call. My question is about ETFs and how we should be looking at them, part of our strategy. And thank you again for taking my question, Alex. And Ms. Avette, you are looking great. and doing a wonderful job.
Great question. Now ETFs are another powerful tool here. Think of them as baskets that give you exposure to entire sectors or themes. The trick is to be patient and opportunistic. When a strong ETF, say one focused on tech or global growth, pulls back 10 to 20%, that's often the sweet spot. Buying into those dips means you re-entering at a discount, and historically those entry points have delivered outsized returns. When the cycle turns back up, it's like buying quality merchandise on sale, but with compounding power behind it. So as we head into the new year, the goal isn't just to chase the rally. It's to build positions in growth stocks and ETFs with a strategy that respects volatility. Dollar cost averaging keeps you disciplined, and buying ETFs on meaningful pullbacks sets you up for long-term gains. If the rally comes, you're already in. If it doesn't, you're still building at attractive levels. Either way, you're playing the long game, and that's how investors win.
Well, there you have it, Terence. I hope that gave you some solid insight into ETFs and market strategy. Now, Alex, before we wrap, any final tips or investment plans you're eyeing as we head into the new year?
Sure. And also, Terence, great question, man. That's the kind of curiosity that builds real wealth over time. Now, if I had to leave viewers with one final tip heading into the new year, it's this. Don't just invest in stocks, invest in discipline. The market moves in cycles, but your discipline, that is what compounds and starts moving the decimal points. Whether you're dollar cost averaging into growth names like Palantir or Nvidia, or waiting for that sweet 15% dip in a global ETF, the magic isn't in timing perfection. It's in showing up consistently. I've seen too many people get shaken out because they didn't have a plan. So, build a plan, stick to it, and let volatility be your ally, not your enemy. Personally, I'm eyeing a few plays. I got my sights on some AI infrastructure stocks. One name I'm quietly watching is Sanmina. They're not flashy like Nvidia, but they're building the servers and infrastructure that make AI possible. As data centers scale to handle generative AI, companies like Sanmina are positioned to ride that wave. It's not in the headlines every day, but that's exactly why it could be a smart under-the-radar play. The same way you've been doing with Modine. Great call, by the way, but I'm not rushing. I'm building, and that's what I love about this channel. CCI doesn't just chase hype. It teaches strategy, psychology, and how to play the long game with style. So to everyone watching, keep learning, keep stacking, and keep tuning in. Because if you're here, you're already ahead of the curve. Big shout out to the CCI crew for having me on. You've built something special here, and I'll definitely be back. Until then, remember, the best investors aren't just smart, they're consistent.
Thank you, Alex. That was insightful as always. And to our caller, Terence, we appreciate you joining in with such a thoughtful question. This is exactly what makes these conversations so valuable. Real questions, real strategies, and practical steps we can all take together. As we head into the new year, remember, investing isn't just about chasing rallies. It's about learning and building discipline. And here at CCI, we're committed to keeping you informed, inspired, and ready for every opportunity the market brings. That's all for today's episode. From myself, Alex, and the entire CCI team, thank you for tuning in. Stay curious, stay consistent, and have a blessed and financially successful week ahead. See you on the next episode of Chump Change Investments.